So good afternoon, everyone, and welcome to the webinar. And many thanks for attending. My name is Paul Dell. I'm one of the partners here at Raffingers, and I head up our Raffingers Wealth Management joint venture with Tavistock. We deal with all sorts of financial planning and wealth management issues. And today I'm joined by Lawrence Daly, one of our wealth management consultants here at Raffingers. And we're going to run through the ins and outs of equity release. So let me just run through this for you guys. You may have noticed that the Raffingers red has now turned green. This is just to differentiate our wealth management services from our main accountancy practice. Although we're intertwined, it will make the wealth management services instantly recognizable. So without further ado, I'll hand over to Lawrence, who can take us through the ins and outs of equity release. Over to you, Lawrence.
Thanks very much, Paul. Thanks everyone for attending this afternoon. I'm just going to do a brief run through of, I suppose, the evolution of equity release, the various types of products that are available, and then also add in some recent developments that are relevant, I think, in light of what's happening in both the property market and with interest rates finally increasing for the first time in a long time. Generally, in the past, when most financial advisors would have heard the words equity release, it was something that they would have walked a mile from, primarily down to the bad reputations that there were about in the 1990s, when you had the potential for people to be taken advantage of by door-to-door salesmen, almost like selling double glazing, coming in and pitching a product, and then also, you know, the beneficiaries of an estate finding out after the fact that they owed some company money because the interest rate was quite high and had been compounding for a number of years. So in order to restore the reputation of the industry, there was a number of things that happened. One was the formation of the Equity Release Council, which is where most of the product providers now agree to provide products which have certain strict guidelines. Also regulation, there has been a drive for increased professional qualifications among advisors in the industry. And then obviously the main change that we had, which altered the entire picture of equity release in terms of a financial product, was the movement in interest rates, where we went from close to 17% or so when the George Soros broke the Bank of England back in 1991 to zero basically when we had COVID, to 1% now. So the main things to be, I suppose, mindful of that we have today is that we have generally most products comply with the Equity Release Council standards. And what does this mean? Well, it means that for lifetime mortgages, interest rate must be fixed, or if they are variable, there must be a cap on, or an upper limit, which is fixed for the life of the loan. And one of the second main conditions are that you have the right to remain in your property for life, or until you need to move into long-term care, provided the property remains your main residence and you look after the property. You abide by the terms and conditions of your contract. You also have the right to move to another property, subject to the new property being acceptable to your product provider as continuing security for your equity release loan. So in that scenario, you couldn't take a loan of £400,000 on a £1 million home and then decide to downsize to something that you bought for 500,000. It's not likely that that would be acceptable to them due to the impact of compounding. And that impact of compounding is protected by a no negative equity guarantee. And this means that when your property is sold and agents and solicitors' fees have been paid, even if the amount left is not enough to repay the outstanding loan to your provider, neither you nor your estate will be liable to pay any more. And we'll come back to this no negative equity guarantee again further on in the presentation, because there are some, there's some talk that if interest rates continue to go up and if house price growth continues to moderate, that we could be seeing some products coming back onto the market, which no longer have this no negative equity guarantee. But for now, approximately 90% of all the products have this guarantee attached to them. Regulation has been improved. So you must have a specialized qualification, which is required for equity release. So that basically means you have to have a mortgage qualification plus an additional equity release exam from the CII or the equivalent from CMAP. There is talk about requiring equity release advisors to be fully regulated and equity release advice to become regulated as in all other financial advices. That is just talk for now. It hasn't happened yet. So you still have the people who can come around to your door from Age Partnership and from those other providers, and they just simply have to take an exam in order to be able to give advice. They're not regulated financial advisors. And there's also the requirement at the end of the process for an independent solicitor and legal advice to be required. That is to ensure that the individual is fully cognizant of the type of contract that they're entering into, fully aware of its implications, and also to make sure that there's not anyone being placed under duress by, say, another family member or something like that, seeking to have a parent decide to take out a loan on their home. So what has happened really that has made equity release such a compelling, I suppose, opportunity recently? Well, interest rates have been the principal reason for that. Bank of England bank rate was 15% in 1990, and we went to 0.1% until earlier this year. We're now back up to 1%, and this has some profound effects on the equity release market. The Bank of England has begun quantitative easing since the financial crisis. So even though we had about 400 billion of additional borrowing to support government spending during the COVID crisis, gilt rates have been kept very low by the continuous purchase of bonds in the secondary market by the Bank of England. So what does that mean? Well, now that the Bank of England is going to be looking to shift its stance to being less accommodative and looking to fight inflation by raising interest rates, and also ending quantitative easing earlier on this year, we haven't seen interest rates in the sterling yield curve move dramatically. They have begun to rise in the short end and the near end, up to about 2.5% now is the kind of trend line target for that, but they haven't gone up to anything much higher than that. So that means that we still have, compared to historical times, very low medium and long-term interest rates, and equity release products are generally priced off 15-year gilt swap rates actually. So during the course of the last number of years, the marketplace has become very competitive. A lot of new providers have entered into the space. This has primarily been down to the fact that insurance companies and other entities are looking to try and find a way to earn a return for their money when they can't get that return from government bonds. So equity release has become very attractive. So what we have seen is that competition has increased dramatically. There's a lot of very new and innovative products that have been released, and interest rates have also been kept fairly low. So now it's possible to get a loan fixed for life for about 3 to 4%, which I suppose is broadly in line with what long-term house price inflation should be, not what it has been in the southeast of England for the past 20 or 30 years. But that interest rate rise has more or less reflected the wider interest rate increase from 0 to 1%. So that's gone from about 2 to 3% last year up to 3 to 4% this year. So there's a variety of options that are available for you now. So if you just want to have no affordability check, so no need for any income coming in, this is simply a loan secured on your property. You have the most common one of all, which is your traditional lump sum roll-up lifetime mortgage, right? That means that you borrow a lump sum, the interest is compounding, you never have to make any payments, and either when you die or you go into long-term care, the loan is repaid from the proceeds of the house sale. And with the no negative equity guarantee, if the loan has compounded to a higher value than the house, well, then there's no impact on the estate. We also have drawdown equity release, which is where people can elect to have a small initial payment and then the option to take additional payments without the need to go through an application process again. This is becoming increasingly popular to be used in conjunction with financial advisors who use this when working with clients who have smaller defined contribution pensions, which are becoming more commonplace now. Optional payment equity release plans are there to allow people to mitigate the impact of compounding over time on the value of their estate. And you also have income equity release plans, although these are only offered by a number of two providers and they're not as popular as they were in the past. Then you have the types of mortgage you can get where there is an affordability check required. These are retirement interest only mortgages and retirement capital and interest mortgages. So for these types of mortgages, you do have to pass an affordability check. So it would be expected that you would have some form of income, either in the form of a defined benefit pension, state pension, whatever it might be, that could be used to pay the interest on these mortgages. So the most common one, like I said, is the lump sum roll-up lifetime mortgage. So this is the most common where people are looking for a large lump sum. So this could be a simple situation where parents want to make lifetime inheritances to their children. It helps them get on the property ladder. So we can see, someone looking to draw a significant amount of money from their home, maybe a couple £100,000, gift this to their children to assist them with a property purchase. This can be used primarily as well for estate planning, where it could be gifted into a trust if that was the desired, if that's what the parents desired. So these two type of would still be the vast majority of products that would be used today. It would be, large lump sum roll-up lifetime mortgages. These are available from 55 and older, so basically same as private pensions. And there's no confirmation yet on whether that's going to increase to 57 in 2028. But if it goes in line with pensions, then it would increase that year. And the percentage of equity available is dependent on your age, and that's to account for the effect of compounding. So it generally starts at about 40% at 55, and then generally increases in 5% increments every 5 years. Now, these type of factors may change as interest rates rise and the effect of compounding becomes larger, or if also the property market cools down a bit and doesn't increase at the breakneck speed it has over the last 20 to 30 years. The interest rate is dependent on the size of the loan required. So if someone wanted to take a small lump sum, then it would still be possible to get an interest rate in the region of about 2% or so. If someone really wanted to push the boat out and take the largest amount that was available to them, then you would be looking at interest rates are in the region of about 5% now for loans of that size. And as with all equity release products, the interest rate is fixed for life and is repaid on death or moving into care. Drawdown equity release is becoming more popular with a lot of clients now who wants an additional form of a tax-free income. So the underwriting process is basically similar for a large lump sum roll-up. The underwriters will underwrite to a maximum loan size, and that's called your available reserve. The loans are drawn as required. They usually have minimums to account for administration and things like that, for about 5,000 to 10,000. And each time you take a tranche of money from this drawdown product, that interest rate is fixed for life. So each time you might take 1 year to the next, that interest rate is fixed. So it's slightly different from the large lump sum one, where you just take one large loan, which is fixed for life. So if interest rates continue to go up, you could expect each tranche to be becoming more expensive for clients that have this type of product. They can be used to provide tax-free income while working with cash flow planning and estate planning. So instead of having to have the vast majority of your money coming from taxable sources such as pensions, this could be used to provide a tax-free income. And these products are very flexible. Money can generally be accessed within 5 to 10 days of a request to provider, rather than a complicated, time-consuming application process, which would involve going through the requirement to have an offer, the requirement to have a valuation, and the requirement to meet with a solicitor. So using drawdown equity release can be used in conjunction with a client that has defined contribution pensions. So if they have an inheritance tax issue and they have some money in their pensions, they could use drawdown equity release to supplement their income. Then this would allow them to preserve their pensions. Nowadays, it is still possible to transfer pensions through multiple generations of family using flexi access drawdown inheritance. So it'd be possible to have a large pension outside of the estate, pass on to children and grandchildren with no inheritance tax to be paid and only income tax to be paid when the money is taken out if someone died after the age of 75. You're also reducing the inheritance tax liability. By now you have a debt against the estate. This would be a particularly interest to people in the southeast of England who might have homes worth over, £1 million, which is the maximum that you can get with 2 nil rate bands and 2 residential nil rate bands. So you could decide to take some money from equity release, use that to live on, preserve your pension, and then reduce the value of your home by having the debt against it to the limits that are available from you from HMRC. And this is a very flexible, extremely tax efficient, extremely useful when it comes to estate planning, and it works well with a lifetime cash flow modeling, which will be required to see, how much money would you need to live on, and would you be able to get that from using equity release as a means of supplementing income. Optional payment equity release. So client agrees that they may make some payments to cover the interest. Again, here, there's no affordability check. You can decide to repay either the whole amount of the interest or a minimum amount. And this is designed to limit the impact on the value of the estate. The client is not under any obligation to make these payments. That's why they're called optional payments. They can stop at any time, and then the loan reverts to a traditional roll-up lifetime mortgage. So this would be used where clients have some small income, smaller size estate, and they want to preserve the value of your estate to provide for certain plans. So, if they want to protect the value of their home to a certain level, potentially maybe within the bands, they could decide to use an optional payment mortgage to keep that in check. These are likely to increase in popularity in the coming years, partially is to offset the effect of compounding as interest rates rise from historic lows. Income equity release. Well, these plans have been around for quite some time. They're not so popular anymore with the drawdown products that are available. So the product would be priced to provide income over a fixed term. So you'd say 10 years or 15 years. Tax-free income is received each month. So basically in the very same way to a pension or salary, except it's not taxable. So it would normally be used by those who don't really want to have the financial burden of deciding how to invest and manage, large lump sums. These aren't as flexible, and once the term and the amount of repayment is decided to be changed, then a new product must be underwritten. So you can't decide that you want to go from having an income of £500 a month to change it to £700 a month the next year. That would require a new application. Like I said, this would be maybe for the lower end of the market primarily, not so much the high net worth segment, and they're not as popular as they were in the past. So these are now, we're into the ones which do require an affordability check. So we have retirement interest only mortgage. And this is where a client would like to release a much larger lump sum. So for example, with these mortgages, it's possible to get 75 to 85% of the value of the home out. Affordability check would be required. So this is much like the standard application process for a traditional repayment mortgage or interest only mortgage. The interest rates are not fixed for life, but they're generally fixed for a specified term, and then they become variable. So I suppose a bit like first-time buyers, you start off with a short fix, and then you revert to a variable rate. There are some very competitive rates out there now, still available. So less than 2.5% with most providers, and that will be fixed for about 2 to 5 years, depending. So for certain people who want to release a large amount of money from their home, if they want to do something with large gifts or potentially make large investments, then they can do this with a retirement interest only mortgage. These would be suitable for clients who still have defined benefit pension income, business income, rental income, and who are going to need much larger lump sums than would be available with traditional equity release. So retirement repayment mortgages, these are simply the same thing as retirement interest onlys, except now we have much larger payments there. This is again suitable for clients who have the ability to repay and require even larger lump sums in the value of the home. So these have more strict affordability checks. And again, these are becoming very competitive structures, very similar to traditional, interest only or capital and repayment mortgages. 5-year fixed, 10-year fixed rates are available here as well. So one of the main things that people are concerned about when it comes to taking out equity release products is what happens if they want to do something that involves selling the home and they have to repay the loan. This could be, I suppose, if they choose to move overseas, or if they choose to move to a holiday home or something like that down to the coast. So you have two main kinds of early repayment charges, and this is where the providers differ significantly, or some providers will offer you the choice of finding your early repayment charges. Floating early repayment charges, these are based basically on the 15-year gilt yields. The other type of early repayment charges are fixed early repayment charges, which diminish over time. Generally, all of them are gone after about the 8th year. So fixed early repayment charges provide certainty for clients when planning to downsize and sell their house. There's no interest rate risk. Floating early repayment charges allow clients to play the interest rate market. So generally, if interest rates go up, if 15-year gilt yields increase, then there won't be any early repayment charge apart from an administration fee. So obviously in the current environment, those clients who've had floating early repayment charges are benefiting because interest rates are on the way up. But again, you can't predict the future. No one saw COVID coming. If interest rates go down, then the early repayment charges on these type of products can be significantly higher than the fixed early repayment charges that are available from some providers. So the process here, I suppose, is what we simply need in order to start the process off is getting property details, location, tenure, and that'll provide us with an initial quote. We have software that allows us to get quotes from all the providers. A recommendation report is prepared, which requires a pre-sales compliance check. This is basically, similar to what is required for defined benefit transfer business, and that's simply down to the higher risk nature of equity release. This is submitted to provider, and evaluation is performed either desktop or physical. Desktop valuations can be performed where there's a significant quantity of property transactions within the radius of about 1 to 5 square miles of the house itself. An independent solicitor is required for completion at the end of the process when the funds are being released. Timeframes vary significantly. They should only take 4 to 6 weeks. Some providers at the current are taking significantly longer than that. That's just a problem that's going on with the industry due to a massive increase in applications from some providers earlier on this year. So what are the key requirements here? Equity release providers will need a first legal charge on the property. So any existing mortgage will have to be repaid first in order to remove that charge. Will trusts are not suitable as the first legal charge on that property is not possible. Client is required to maintain the property to a suitable standard, and it is best practice, and nowadays the solicitor will almost insist on it, that beneficiaries need to be informed and involved in this decision. So the opportunities that are here, I suppose, is the market is only set to grow, especially looking at inheritance tax, because in the southeast of England now, even average people are likely to have an inheritance tax issue. It is no longer a preserve of the ultra wealthy. The value of homes in the home counties and London area, £1 million house is not anything that's spectacular anymore. So these products are flexible and competitive, and basically can be used working with a financial planner to do some estate planning tasks if that's what the client would desire to save some money on inheritance tax. The main ways you're going to be doing this is either making a gift into trust, or if you're comfortable with your children's marital situation, you can make outright gifts to them. This allows you to preserve pensions. And then these are all potential inheritance tax solutions which equity release provides. So the flexibility that's available now with drawdown products means that when used with pensions, this can be very tax efficient, give your pension more time to grow, increase in value by investment growth over time, and not pay any tax on the income that you take from equity release. And we also see, I suppose, for long-term care, Care annuities are being funded through the use of lump sum equity release. That's becoming more commonplace now for clients who want to have, I suppose, the benefit of being able to choose the care home that they're going to go into and being able to select exactly the type of private care that they want to have. So how are things changing? So we've had a massive amount of activity in the market, which has put a lot of pressure on some providers. So we've had cost of living pressures that has meant some of the lower tier borrowers are accessing equity release very early. Speaking to some of the better providers in the market, they've said that, you know, if you look at what's happened with Age Partnership, their business has gone up by 40% in the first quarter of this year. Their average loan size would be significantly lower than, you know, most other providers. And we're getting a situation where the regulators are becoming a bit concerned about what's going on in the market. As a result, things are kind of in flux with some providers in terms of providing loans in the timeframes that they traditionally would in the past. So what do we have is there's two things that are coming to fight at the market at the same time. So we have interest rates going up, and we also have the outlook for the property market to expect to cool down, maybe not go much past that, but not to increase at the same breakneck speed it has over the last 20 or 30 years. So what you're seeing coming on here, products with no equity release council guarantee, and if the client is willing, in order to get a larger sum without the need to repay during their lifetime, a charge against the estate is possible. We're also seeing the introduction of some split products. So this would be where you have a conventional mortgage and a lifetime mortgage if you want to have a higher release from the property. We're also seeing that, you know, normal mortgages are changing. So we're becoming a bit more like Japan now. So conventional mortgages for about 30% providers no longer have any upper age limit. So that's a change from the past when, you know, it would be hard for borrowers in their 70s to get a conventional mortgage. That's no longer the case. It's simply down to affordability. Your state pension can always be included in any affordability check. So what we're likely to see here is that housing wealth will likely to be accessed more readily over the coming years. The retirement of baby boomers with their defined benefit pensions means that the next generation coming through, Generation X, will have to rely on their defined contribution pensions. And the average pot size for a defined contribution pension in the UK is still only £30,000. So that's not going to keep you going for too long if you're going to be taking £5,000 or £10,000 a year from it. So people are going to have to rely more on their homes to provide funds for them in retirement. And also the general outlook is that the property market will probably cool down as the impact of interest rates is seen. And we may see that, you know, after 3 decades of breakneck growth, maybe not increasing at the same rate as they have over the past decade or so. So if anyone has any questions, pop them into the question box. And let's see if I can access that. No open questions unanswered.
Thank you, Lawrence. You know, there were a few questions early on which I sort of
dealt with. Yeah, that's no problem at all. Yeah.
Reply to. But no, thank you for that.
No problem at all.
As you can see, guys, it's quite a complicated area, and as we would always say, it's important to take proper advice. Equity release has become a useful tool very much in estate planning now. We tend to use it quite a lot in estate planning, in conjunction with gifts to children and sort of lifetime cash flow modeling and stuff like that. So if you require any further information on it, then by all means contact myself or Lawrence. Details will be in the email that comes out after this, or talk to your relationship partner at Raffinger's, and we'll be pleased to assist. But I've got no more questions, Lawrence. So
very good.
I think we're done. So thank you once again, guys, for attending, and we'll hopefully see you at the next one we do. But
thanks very much.
Goodbye for now.